Imagine this for a moment. You walk into a bank, calm, responsible, doing what you've been told. Your whole life is the right thing. You deposit your hard-earned money and feel a quiet sense of relief. It's safe now, protected, growing slowly in the background. At least that's what you believe. But here's the uncomfortable question most people never ask. The moment your money enters the banking system, whose money is it really working for? Because from that exact second, it stops behaving the way you think it does. It doesn't rest, it doesn't wait. It gets deployed, leveraged, multiplied, and monetized, primarily for the institution holding it, not for you. And if that idea feels unsettling, it should. Because once you understand how this system actually works, you will never look at your bank account the same way again. Most people assume the financial system exists to help them save, grow, and feel secure. In reality, it is designed around very specific incentives. Those incentives don't make you wealthy. They make you predictable, dependent, comfortable enough to stay quiet. In this video, we're unpacking 14 financial realities that banks rarely explain openly, not because they are illegal or hidden, but because most people never stop to question them. And once you see them clearly, you can't unsee them. Let's begin with the first and most misunderstood truth. Keeping money in a traditional bank account often makes you poorer over time. This sounds counterintuitive because banks are framed as symbols of safety. You deposit money, earn a small amount of interest, and assume you're being responsible, but numbers don't care about intentions. Imagine placing $1,000 into a savings account, earning 0.5% annually. After a year, you earn $5. At the same time, inflation quietly reduces the real value of your money by roughly 3%. That's about $30 of lost purchasing power. You gained 5 and lost 30. The feeling of safety masked a real loss. Extend that logic across years or decades, and the pattern becomes clear. Money sitting in low-yield accounts slowly leaks value. Banks call this stability, but stability for them means access to cheap capital. Your deposits are not idle, they are lent out at far higher rates, sometimes 15, 20, or even 30%. You receive a token return while your money fuels their profit engine. The second reality surprises most people. Banks expand the money supply through lending. While governments and central banks control base money, commercial banks legally increase the amount of money in circulation through credit creation. When you deposit $1,000, the bank keeps only a fraction in reserve. The rest is lent out. You still see your full balance. The borrower sees their loan as new money. The system works because trust holds it together, and banks earn interest on money that didn't previously exist in that form. The third reality involves credit cards, one of the most effective financial products ever created, not for consumers, but for lenders. Credit cards feel flexible and empowering. Buy now, decide later. But with average interest rates around 20%, carrying a balance turns time into an enemy. Minimum payments stretch debt across years. Banks don't profit when you pay in full. They profit when balances linger. A simple purchase quietly doubles in cost, all while feeling manageable month to month. The fourth truth often feels unfair. The wealthier you are, the cheaper money becomes. Risk models reward those who already have assets. If you struggle financially, borrowing costs you more. If you're wealthy, loans are offered at extremely low rates, sometimes below inflation. Wealthy borrowers let inflation reduce the real value of their debt, while average workers pay a premium just to participate. This leads directly to the fifth reality. Debt is not inherently dangerous, but it is asymmetric. Used strategically, debt allows asset holders to benefit from inflation and leverage. Used poorly, it finances consumption and depreciating items. Banks understand this distinction deeply, which is why lending terms differ so dramatically depending on who is borrowing and why. The sixth reality explains how banks help facilitate legal tax efficiency for the wealthy. Instead of selling assets and triggering large tax bills, asset-rich individuals borrow against what they own. Loans are not taxed as income. Banks earn interest, borrowers access liquidity, and assets continue compounding quietly. The system rewards ownership far more than effort alone. The seventh reality is global. Trillions of dollars sit in low-tax jurisdictions, legally structured through multinational frameworks. Corporations and wealthy individuals shift profits using systems designed and maintained by financial institutions and tax professionals. The result is reduced tax exposure for some and increased burden for others. The eighth truth challenges a common belief about homeownership. Mortgages are often framed as automatic wealth builders, but over decades, interest payments, taxes, insurance, and maintenance can exceed the original purchase price. Housing can build wealth under the right conditions, but banks profit regardless of market direction. The ninth reality hides in plain sight: fees. Overdraft charges, maintenance fees, penalties, and transaction costs generate billions annually. Individually, they seem small. Systemically, they are enormous. A minor mistake can trigger a disproportionately large charge, effectively imposing extreme short-term interest rates on those least able to afford them. The 10th reality explains why debt is aggressively marketed. Savings earn little, borrowing costs a lot. Student loans, car loans, and revolving credit create long-term, predictable income streams for banks. Debt isn't a flaw in the system, it is one of its primary products. The 11th truth reveals risk behind perceived safety. Banks don't simply store deposits, they allocate capital. When those allocations fail, institutions are often protected to preserve system stability. Individuals, however, experience the consequences directly. Your money's safety depends on decisions made far from your view. The 12th reality is painful. Poverty is expensive. Those with fewer resources pay more for basic financial access. High interest, alternative financial services, and penalty-based products disproportionately affect the poor. It functions like a quiet surcharge on vulnerability. The 13th truth is subtle but powerful. Financial confusion is profitable. Personal finance is rarely taught systematically. Complexity benefits those who understand the rules. When people don't understand compounding, credit, or opportunity cost, poor decisions generate consistent revenue for institutions. The final reality holds everything together: trust. The system functions because people believe their money is available when needed. If that belief falters, the structure becomes fragile. This is why banks invest so heavily in appearances of stability and permanence. At this point, it's important to be clear. Banks are not villains, but they are not caretakers of your future either. They respond to incentives. Understanding this doesn't mean avoiding banks, it means using them deliberately. Here's a personal lesson I had to learn myself. I used to treat a bank account as a place to store money and feel safe. Over time, I realized that safety without intention is just stagnation. Now, before I send money to a bank, I ask one simple question: what is this money's job? Emergency money prioritizes access and stability. Long-term money cannot afford to sit quietly, losing purchasing power. The moment I stopped outsourcing responsibility and started assigning purpose, my relationship with banks changed completely. So what should you do instead? Not theories, not hype, just 3 practical principles. First, separate purpose. Keep emergency cash accessible and boring, but don't confuse it with long-term wealth. Second, minimize friction. Choose accounts with low fees and high flexibility, because every unnecessary cost compounds against you. Third, protect purchasing power. Over time, money meant for growth must have exposure beyond idle cash, aligned with your risk tolerance and time horizon. Banks are tools, not strategies. The goal isn't to fear the system. It's to stop being unconscious inside it. Knowledge doesn't guarantee wealth, but ignorance almost guarantees dependency. Once you understand how money actually behaves inside modern financial systems, you stop playing defense and start making intentional choices. And that awareness is the real first step toward financial freedom. Thanks for watching.